Hello everyone, this is Fred, and welcome to another video of Investing Wise Academy channel video. And today, we will talk about Michael Burry, or the broken clock, as they would like to call him. Michael Burry made billions not once, not twice, but 3 times. That's correct. He foresaw the dot-com boom, the Great Recession of 2008, and the most recent market drop. Although the market has already plummeted dramatically, Burry feels this is only the beginning. He still believes the market will drop by more than half from the present. This video will show you how Burry has made millions and how you can do the same with your portfolio. Habitually, be 1 to 2 years early on everything, and you too can reach a shattered clock. Burry recently tweeted, Burry predicted the market meltdown in late 2021. Even though it's been a while, the situation has played out just as he expected. He predicted rising inflation, a fall in growth stocks, a market correction, and a bond market crash. Burry is usually early, yet he always manages to get it right no matter what. The predictability of human nature is one of the main reasons why Burry can foresee market disasters. While technology advances, human behavior remains constant, and history bears this out. Third time a charm, 10 years leading to a financial crisis, yellow S&P 500 to 2000, white S&P 500 today, green dough 1929. Got to love human nature, nothing if not consistent, Burry added. During the dot-com bubble, the yellow line reflects speculation. Before the Great Recession, the green line resembled the booming 20s. Both of these times saw unprecedented financial risk, resulting in a steep drop. Unprofitable internet stocks rose 1,000 or even 2,000% during the dot-com bubble before falling to nothing. There was also a lot of speculation in the roaring 20s. Within 9 years, stock prices had tripled, and the majority of investors believed that prices would continue to rise. Burry used a newspaper to demonstrate how absurd the speculation was. Even though the market had fallen for the day, a rebound after the market closed satisfied brokers, according to the headline. Both of these bull runs speak to one type of behavior: greed. While the market may recover in the short term, Burry believes the market will fall in the next 1 or 2 years. After 2000, the Nasdaq had 16 bear market rallies above 10%, averaging 22.7% before bottoming down 78%. After 1929, the Dow had 10 bear market rallies over 10%, averaging 22.8% before bottoming down 89%, he said. Burry suggests that the market will see short-term rises, but this should not be mistaken for long-term recovery. He continued to clarify his prognosis by adding, dead cat bounces are the most epic. 12 of the top 20 Nasdaq one-day rallies happened during the 78% drop from 2000's top 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top. This tweet highlights an intriguing and deceptive link. During long-term market collapses, the market always rises the greatest, which is incredibly misleading. Burry has identified several correlations, but we all know that correlation does not imply causality. Michael Burry has identified several alarming fundamentals that support his prognosis. First, everyone is aware of the dire macroeconomic condition. Some economists believe the situation between Ukraine and Russia is on the verge of collapse. Others would argue that China's economy is weak or that US interest rates will continue to rise. These macro scenarios may be correct, but only one component, the consumer, will finally bring the economy down. The consumer is the sole driver of the economy. Personal consumption expenditures account for over 70% of the US GDP. The entire economy will collapse if the consumer feels weak at any time. The present macro issue is around the consumer's declining purchasing power. The economy will crumble if we stop consuming so much and start conserving. Burry said that this is the problem. Last 18 months, minus $850 billion in direct steam checks, $400 billion in cash-out thrift fees, $1 trillion plus in forgivable loans with $250 to $500 billion of it fraudulent, another $4 trillion indirect, etc. What recapitalizes the consumer now? Higher wages can't do that. Price rises are soaring across the economy, and customers like you are beginning to believe that your money is worth far less. This drop in purchasing power isn't just a coincidence. A plethora of evidence indicates that consumers are at their lowest point in history. The University of Michigan Consumer Sentiment Index is the most well-known consumer sentiment indicator. Unfortunately, the Consumer Sentiment Index at the University of Michigan is now at historic lows, which indicates that customers are vulnerable. The slowing of Amazon's sales is another symptom of a weaker consumer. The first quarter numbers for Amazon were disastrous, with revenue only increasing 7% yearly and profitability falling short by a significant margin. Amazon has become the principal marketplace where most people buy their items in the modern era. The bad quarterly performance of Amazon demonstrates how vulnerable consumers are. Burry tweeted, "And so Amazon says to GDP, there's your weakening consumer." So given all of this information, how has Burry made millions? How can investors do so as well? Lower business margins, according to Burry, will be the first economic consequence of weakened customers. The effort for firms to keep their pricing high will be at the forefront of this. Consumers are more vulnerable than ever, forcing firms to decrease costs. The problem is that earnings do not vary very often. As a result, salaries will stay high in comparison to prices. Businesses' profit margins will shrink significantly due to decreasing costs while paying increasing wages. As a result, equities will eventually trade at lower price-to-sales ratios following a significant drop in sales. Burry is building his portfolio to profit millions, if not billions, of dollars by shorting bonds in the coming year. In late 2021, he announced that he was shorting 30-year Treasury bonds. He tweeted, "For what it's worth, I've never shorted any cryptocurrency. This is my third bubble and the biggest. I've learned a thing or two. 30-year treasuries, on the other hand." Burry's motivation for shorting bonds is self-evident. Inflation had accelerated to over 7%, but 30-year bond rates were still hovering around 2%. So in the short run, bond investors were virtually sure to lose 5% every year. Moreover, bond yields and prices have an inverse relationship. Bond prices plummeted as bond rates rose. TBT, the ProShares Ultra Short 20-plus year Treasury ETF, is an ETF that short sells a bundle of bonds that Burry has previously acquired. Bond yields have risen dramatically in recent months as interest rates, inflation, and the Ukraine crisis have increased. Bond prices have plummeted as a result while TBT has risen. Since Burry initially announced a short position, the TBT ETF has gained by approximately 43%. That's a lot of money, but Burry expects to make much more in the future. 1977 says hello, Burry tweeted lately, along with a photo of himself from 1977. This was a reference to the 1970s economic crisis. Unprecedented levels of inflation characterized the Great Recession of the 1970s. In 1977, inflation was 6.5%, but by 1980, it had risen to above 14%. This is a case that is remarkably similar to ours. Inflation is now about 8%, but Burry believes it could soon reach 10%, if even 15%. The fact might be that inflation has already surpassed 10%. Burry doubts the Consumer Price Index or CPI, which calculates inflation, He explained how the CPI says housing costs rose 5% last 12 months. Wrong. CPI would be 12% using real-world NAR housing data. BLS has smoothed out housing numbers forever because home prices have been a problem. So next month, they will start smoothing out vehicle prices. Hashtag problem solved. Burry is essentially claiming that the CPI's house prices are far wrong. According to the CPI, home prices only increased by 5% in the previous year. This is unquestionably false. If real-world housing statistics were used to calculate home prices, CPI inflation would be 12%. That means the current inflation figure of 8% is 4% off the mark. This error and other macro variables will force the market to drop by around 55% from present levels. Burry clarified how there were paradigm shifts or speculative peaks. The S&P 500 bottomed 13% lower than 2002's bottom in 2009, 17% lower than 1998's long-term capital management crisis low in 2002, and 10% lower than 1970's low in 1975. 15% lower than the COVID low is SPX 1862, roughly Shiller P28 of 16, nominal P28 of 9 in historic range. Michael Burry observes a pattern of market disasters getting increasingly severe over time. If this trend holds, the S&P will crash to a level that is just slightly lower than the COVID crash. Burry uses 15% as an example to explore if this is theoretically possible. For instance, if the S&P 500 were to drop to a level of 15% lower than the previous low during COVID, the index would be around 1,800 points. This is about 55% lower than current levels and would return the index to its historical price levels. Burry included a graph in his tweet that displays the Shiller P/E ratio through time. The Shiller P/E ratio is a cyclically adjusted P/E ratio, which implies that it considers inflation. At the moment, the Shiller P/E ratio is 36. This ratio would drop to around 16 in a 55% decline, which is in line with the historical norm. Burry also included a graph depicting the historical average of the nominal P/E ratio, which is just the price-to-earnings ratio for the previous 12 months. We have a P/E ratio of 21 right now. A 55% drop would reduce this to around 9. A P/E of 9 would be somewhat below the norm, which Burry considers fair. All of this supports his forecast that the suffering would continue. Some of you believe that short-term market collapses have no impact on long-term stock investments. This is true if you can take the psychological trauma of seeing your portfolio plummet. However, short-term crashes and long-term profits are inevitable for significant firms. During the dot-com bubble, Amazon was one example of this. Burry questioned, how far can the stock of a good growing company fall? One destined to be one of the greatest companies in the world. Remember when Amazon fell 95%? But the Fed didn't have inflation like this hanging over its head then either. If you aren't willing to sustain belief in a stock that has dropped more than 95%, the stock market may not be for you. But unfortunately, short-term volatility emotionally impacts all investors, and regulating that feeling is exceedingly tricky. Another clue pointing to a potential drop is trade volume related to volatility, because there are more purchasers on both the buy and sell sides. Trading volume tends to be higher during market collapses. The current trading volume of outstanding shares is at an all-time low. Burry described, top to bottom, Microsoft traded 5.2 times at its shares outstanding by 2002, 3.3 times by 2009, and 0.5 times so far. Amazon traded 5.7 times by 2002, 6.6 by 2009, and 0.9 times so far. JP Morgan traded 3 times by 2002, 5.9 times by 2009, and about 0.7 times so far, etc. Enough takes time. To make the market comparable to prior collapses, trading volume must expand 5 to 10 times from current levels. This is because the market has a larger trading volume when prices are low. To match the trading volume of prior market crashes, the trading volume would have to rise dramatically. Michael Burry is not a financial counselor, so keep that in mind. He's just a hedge fund manager who stands to make a lot of money if the market crashes. So always conduct your research and invest at your own risk. Given Burry's track record, I would not dismiss his projections. For example, he recently tweeted, "At least I tried," because the traditional banking system never listens to him. Please let me know if you believe the Big Short 2 will arrive shortly after Burry makes billions again. If you like this video, please press the like button and subscribe to be updated. Thank you for watching, and again, this is Fred. See you on the next one.